Hello, I'm Michael Wildeveld with Exit on Your Terms. What is your company worth and what can you do to increase it? It's a question that a lot of owners will say they know the answer to, and they don't. Unless they go to market, run through a process, have a competitive bidding process, you're not going to know what it's really worth until you close on a transaction and someone's paid. You can still estimate pretty well what a company is worth. That's kind of the easy part. We created a value estimate tool to get you a little bit of the way there. Really, I'd recommend a certified valuation by a credentialed professional evaluator. That's somebody conventional with the AICPA, NACVA, somebody that actually looks at it as a profession. They're not just putting something on paper. It's not an automated online project. They'll typically know it's real if they're spending 40 plus hours creating it, and it's probably going to cost you $8, $10 plus $1,000, up to $30, $40,000, depending on your size and complexity. It's actually worth it. I'm cheap. I'll tell you, it's actually worth it. What's it worth? That's a complex discussion. Let's focus right now on how you can increase it. Every owner will have a business that's worth A. You could increase it by what I'll say are three different means. Number one, the obvious answer most owners gravitate to because it's what they're comfortable with and what they're used to. We can increase our EBITDA. We can increase our net income, our seller's discretionary earnings, however you want to define it. Yes, you can increase it that way. Chances are, if it was that easy to do, you already would have done it. That's step one. You can work with value advisors that'll do exactly that. And they'll focus on your processes, cost improvements, scaling, new marketplaces, new products or services, yada, yada, yada. The real way to increase your value is by reducing your risk. So if number one is increasing your top line revenue or your bottom line revenue, that increases your output, your EBITDA. If you address your company's risk profile, the company specific risk that your company has, by moving that risk profile to be lower, your company will become more valuable. If you think of it in terms of a multiple, you're increasing your multiple at the same time. That applies leverage. That same EBITDA worth a multiple that's 2-3 turns higher, it'll provide greater results than just increasing your EBITDA. You could dramatically increase your EBITDA, but if you could move your multiple to be much higher, that's going to apply much more leverage to those earnings to give you a much greater benefit. So we'll tell folks, take the low-lying fruit when it comes to increasing your EBITDA if you can, if it's there for the taking. Of course you want to do it. But what you really, really, truly can control is the risk profile of your business and reducing that risk to move what your multiple is. There's another component of this, which is kind of the third component. So first one is increase EBITDA. Your business is worth more, obvious. Increase your multiple, which conversely, lower your risk. Your multiple goes up. And that's where you're going to experience an even larger impact on your company value. Number three, tax planning. May not impact your company value, but it will impact your net proceeds. Most people say, I want to get the most out of a transaction. Getting the most, we assume that means highest top line revenue or sale price. If you think about it as in terms of your net proceeds, you're going to get the highest amount of net proceeds by minimizing your tax burden. Most owners are going to pay a combination of capital gains in their sale, and they're going to pay ordinary income tax in their sale. You're going to have a tax basis that could affect this. There's a lot of factors that could affect it. Your non-compete agreement, your consulting agreement, the basis you have in your assets or your company. If you can move what your taxes are, let's say the spectrum is from 0% in taxes to, let's call it 50 for ease of numbers. If you can go from 50 to 0%, you're doubling your net proceeds from the sale. That's extreme, but everything's possible. It's worth exploring. So if you look at the three ways of how do you get more out of a transaction, make more money, become a more valuable company by reducing risk, or mitigating your tax burden, to all three, accelerate your value. So that's how to get more out of the business. Now, what's your business worth? Start off with our value estimate calculator. It'll get you in the right ballpark. It's based on up to 40,000 historical transactions that have been documented. We apply over 2,000 NAICS, NAICS, or SIC codes specific to your industry. So these are on actual transaction methodologies. And then we'll look at those comps in the aggregate. We're not going into each comp separately in an automated tool. But that's what a proper valuation will do and should do. What we'll do is apply those typical multiples, and we'll look at questions we've developed based on our heuristic knowledge of selling over 1,000 transactions, knowing what moves the needle for a buyer and drives value. We'll apply the two of them together and give you an output to say, this is the range you might be able to expect in a business sale. Depending on your size, we'll know whether that working capital might be included or might not be included in a transaction, how inventory will be treated, and how other assets will be treated. And then we'll give you a quick plan. And I'll say, here's 5 steps, 5 ways to increase your value. and how you can go about it together with your advisor, ideally your financial planner, your exit planning advisor, your wealth advisor, and your tax planner, maybe all involved. And that would be the way to get the most out of a transaction. We hope you found this helpful. It's a complicated topic. If you go to exitonyourterms.com, we have tools to address each of these different variables. Just in this conversation, we spoke about value estimate. First, you should figure out what you're really making, discretionary earnings, to then put in value estimates. We have a calculator for discretionary earnings. Then you'll go into value estimate calculator, see about what your company is worth. You get tools and tips on how to increase that value. Then you could skip to net proceeds if you want, and you can see this is what I stand to make from a company or walk with from a transaction. We'll share with you a few different tax mitigation strategies so you could see how you could engineer your outcome together with your tax advisors and your legal team, or maybe even your estate planning team. And then you can move on to some of our other calculators or assessment tools to say this is the type of exit makes the most sense for me. If you look at your exit path navigator, or if you look at what your priorities are in our priority assessment tool, and you'll say this is what makes most sense, this is where my heart is, and now these are the exit paths that align with that. So we have the whole suite of 12 tools to help you answer all of these questions, to get you the clarity that you need, and ultimately, hopefully, it'll end up with you being able to get the most out of your company valuation, increasing the value, not of your company, that's the question that's asked, but of what you walk with after a transition's done. Thank you.